Buddy, welcome, welcome, welcome. Going to be talking all about the all-in-one loan. So give a couple of people a little bit of opportunity to log on here. We're right here live on YouTube, Facebook, and LinkedIn. So thank you guys for joining. Appreciate you guys being here. And it's really going to talk to you. It's really something about guys that I'm really passionate about. I travel speaking about this product, um, and it's really an incredible opportunity for every one of us who are involved in and around the housing market. This is not just another mortgage program. In many ways, we feel like it's the solution to the mortgage itself. So I'm going to go through a few slides here with you. And so really, this is really an alternative to traditional financing that we have. And it's a unique opportunity for all of us in and around the housing industry. Those of us who are agents or housing professionals, financial advisors, fiduciaries, holistic planners, clients, homeowners, it really presents an opportunity for pretty much anyone and essentially who's in and around the market itself. So today, what I'm going to do is an overview. I'm going to talk about the history, what it's intended to do, how it's structured, who it's good for, how it works on a day-to-day basis. I'm going to give you some resources, and then at the end, I'm going to answer some questions. So let's hop in. So, when we talk about mortgage innovation, those are two words, mortgage and innovation, that really you don't really hear in the same sentence very often. And not really talking about credit risk tolerance and guidelines. Those sort of ebb and flow with the times, but I'm actually talking about re-engineering the loan product itself. In America, we're really blessed to have easy access to credit. It's very easy to get home financing, especially when you talk to people in other countries. However, mortgages are very stale instruments, and they're used to finance the purchase of one of the biggest expenses that we have in our lifetimes. And for anyone with a mortgage, long-term debt really creates really a huge burden, and it's one of the largest commitments to an expense really about all homeowners. So we view the all-in-one loan as a solution to that. It helps people really achieve a variety of opportunities, and we're going to talk about those tonight. But before we dive in too deeply, I think it's important to understand that the idea of the all-in-one loan, it's not a new one. There's been similar products that have been developed globally around for many decades throughout Western Europe, as well as Australia, New Zealand, Canada. And they're commonly known there as offset mortgages and money merge accounts. Now, in some of those countries, the innovation was fueled by the removal of any tax benefit for paying mortgage interest. And in some of the others countries, banks just simply wanted to create a stickier, longer lasting relationship with their customers. So here in the US, the products referred to as universal accounts, zero balance accounts, or ZBA accounts. You can actually Google those, sweep accounts. Also, very familiar with the all-in-one loan. There's characteristics very similar to the all-in-one loan with commercial lending. So in commercial lending space in America, we had access to these loans, but not until 2005, where we had where it was brought to the market in the U.S. So, let's talk about what it is. It's a privately secured mortgage product pioneered by CMG Financial in 2005. It not only provides borrowers with the financing needed for their home, but also the ability to pay off their principal balance significantly faster than a traditional loan. And it generates tens of thousands of dollars in saved interest expense without changing your monthly budget, without changing your minimum monthly payment obligation, and without relying on interest rates to move forward. Now, we know that, when we talk about the all-in-one loan, saving enormous times and money, even though that's true, what happens is, people are really reluctant to pay down their mortgage with a traditional loan. They're resistant to do so, really because there's really a disincentive to do so. Anytime you pay your mortgage faster or pay a money towards your principal, what's really happening is you're not able to get the money back. So with the all-in-one loan, it does so you're paying principal down automatically without changing anything to your monthly budget or disrupting your lifestyle, and it does so without having to change interest rates. So you have greater control, flexibility, savings advantages, and we know in this industry, opportunities tend to exist when the interest rates come down, making home buying more possible, more affordable. And behaviorally speaking, that's all really defined by interest rates. But here's the thing: what if we didn't really have to depend on interest rates and other factors which are beyond our control in order to make home buying more affordable? What if we didn't have to wait for things to get better? And this is why the all-in-one loan was created. At CMG, we view our role as a consultant, and we take that role very seriously. And we really try to dive deep and explore why you'd want to explore something that's not really a one size fits all. You may have greater things to think about. Maybe the 30-year loan being the most expensive loan that you can get isn't that suitable for you. The 30-year fixed loan is also the most profitable loan, it happens to be, for the mortgage lender. So let's look at some alternatives, and the all-in-one loan is one of those alternatives. So here's the thing: why reimagine the mortgage itself? Why reimagine a mortgage? Well, here's the thing: we think the why is important. We think the why is good for our industry because we need to think about, why would professionals commit time to this? Why would real estate professionals, financial advisors share with their clients something like this? Why would we commit time and energy to make sure that we're including this in our conversations? Well, the thing is, we really want consumers to have greater control over their housing debt, and there's really several reasons why we'll cover here. At the end of the day, most people really need to borrow to own real estate. Interest rates are the primary driver of their decision making, and long-term loans are used to offset interest expense. And more than 90% of borrowers use a 30-year fixed mortgage. But we know incomes are not keeping up with home prices. That's pretty easy to see. I mean, they're skyrocketing. But also think about this: the pace of new home ownership, meaning the pace at which people are entering the market for new home ownership, is lower. It's at a slower pace than the increase in the mortgage debt. In other words, the U.S. has taken on more mortgage debt, even though rates have been like really, really low, and they've been very favorably low. There's been more debt taken out at a faster pace than new homeowners have entered the market. So something is wrong. Something is really wrong. Something's not right. Why, when we have access to low interest rates, are people taking on more mortgage debt and people are taking on home ownership? It's really odd, right? And again, long-term debt erodes cash flow and wealth building potential. Studies show that there's a huge gap between what's needed for retirement versus what people actually have saved. We're talking about somewhere between $7 and $14 trillion deficit for retirement. This really shows that 20 million retirees will live in poverty in the next 15 years. We're literally going in the wrong direction. And we really feel like we're partly responsible for this in the mortgage industry. There's no greater debt on a monthly basis than a mortgage. 42% of all monthly debts are made up by the typical household's mortgage. And even though we know that paying debt is faster, people are reluctant to pay. There's only 4% of people pay extra on their mortgage on a regular basis because it's such a large portion of their expense already. Now, I want to go through, here's some pros and cons to traditional mortgage financing. When I talk about traditional mortgage financing, I'm talking obviously about conventional loans, Fannie Mae, Freddie Mac, FHA. And, you know, the pros are, you have a low down payment it's really great for first time buyers. There's a lot of familiarity with the product. There's very little education involved. They're certainly readily available, a market commodity, and they really provide payment dependability with benefiting those with, a stretched budget really the most. But there's some downside. They're slow. They take decades to repay. They're inefficient. Interest is front loaded. We'll talk about that more. They're very rigid. Money flows only one way in this instrument. They're very expensive. Even with low interest rates, mortgages cost significant amounts of interest. And because of their rigidity, there's increased risk, right? You can't miss a payment if you lose your job, right? You can't miss a payment if things get really tight. You can, but you're going to get what? You're going to get a late. You're going to get a late pay or delinquency. What if you didn't have to worry about that? What if you had a loan that would actually pay for itself until you get back on your feet again? And that's really what the opportunity here is it's really an opportunity. This loan was created to provide a safer avenue. And just wanted to share with you, there's never been a delinquency in the history of this loan. And certainly that would mean, and a delinquency is what, 30-day late, 60-day late? And that certainly means there's never been a default in the history of the loan. So it's an enormous opportunity to build wealth. Now you may be thinking, look, I've already got a really low interest rate. Why would I even consider giving that up? The problem, though, with the 30-year loan has very little to do with the interest rate. It has everything to do, really, with the predetermined agreement that you make on paying interest for 30 years based on an amortization schedule that's already preset for you. So if you think about it, what's going on, it's really the length of time that you're in a mortgage that is the problem. Interest is front-loaded on a traditional mortgage. It means interest is paid first. If you can imagine your money hitting this financial tool in this graph from left to right, 50% of the total interest will be paid in the first 10 years, despite having a low interest rate. I mean, it's really incredible. In fact, it's about year 22 before you're paying as much in principal as you're paying on a monthly basis in interest. So I'm going to go through a little math here. Let's talk through a little scenario. The cost of money is very high, whether rates are high or low. If you take an $800,000 purchase price, somebody puts down 20%, they've got a loan at 6%. That person is literally signing up for a 73% increase in home price right off the bat. You're talking about an amount of $1.3 million that they're signing up for. It's an incredible amount of money. And you think about the last page of your truth in lending statement, we talk about the TIP, the total interest percentage. In this case, your total interest percentage would be 116% of interest in relation to amount of principal. It means you're paying for the house more than 2 times. You're paying for it once for yourself and once for the lender. But you say, well, look, I've got a 3% rate, or I've got something lower, right? Sorry, that's a little bit jumbled up there. But what this is illustrating is 3%. At 3%, the interest rate, you're really paying still $52 in interest per $100 in principal. You're still signing up for a 23% increase in home value or home payback. Does that sound like a good deal? Sorry about the jumbled up part on that. So what if I told you that you have the ability really to turn the tables? That you can become the bank of you. The all-in-one loan is really a loan that pays principal first. It's a loan with a simple math. Any loan is a simple mathematical equation with 3 components: the rate, the time, and the principal. But what we typically do in America is we recycle every 5 to 7 years by refinancing or starting the loan over, and we start the entire debt cycle all over again. So, but here's the thing: if you can change the trajectory of this equation, you can literally change the trajectory of your life. And I'm going to share with you some testimonials in a bit where people are talking about how life-changing this is. It's a very valuable conversation to have. So let's talk about a little bit how it works. Sorry, we got some jumbled up words there. We'll try to fix that. in the future. So here's the thing about the all-in-one loan. It has a unique feature. It has a two-way sweep function. So money can flow into the account, into the bank account, and then it sweeps and pays down the balance of your loan. And that you manage your bills in the same fashion you would today. So it's a hybrid product. It's a bundling of services. It's one part mortgage, one part checking account. It provides this enhanced engagement between your mortgage and your checking account. Now, these are two products that we're all proficient at using: a mortgage and a checking account. So by bundling your mortgage and your checking account into one product or one bucket, you're saving more in interest than you could possibly earn in the bank, which is saving you time and money, right? I'm going to just pause 1 second, see if we can fix the jumbled up part. It's still showing on the screen. All right. Okay, let's keep going. Okay. Okay. So think about, let's see here. Think about your checking account for a moment. We all have one. Every borrower has one, uses one regularly, and they help manage more money in 5 years than we typically owe on a mortgage. That money can sit idle for days, weeks, even months before you really need to pay your bills. And think about regular bills and expenses being spread out over time while your deposits are sitting idle for days, weeks, and even months. We don't pay all our bills on one day, right? We don't pay them on day two. But deposits, they earn much lower interest than the interest rate charged on mortgages. Banks loan out our deposits. You got to think about this. Banks loan out our deposit to make new loans to other people. And when they do this, they make anywhere from 400 to 1300%. Google sometime how much money banks make on our deposits. You ever note, like, it's not like your money's just sitting down there in a lockbox waiting for you to go get it. They're loaning the money back out immediately. It's, if you haven't figured this out, guys, the banking system and really the world is operating on one big arbitrage system. The banks are getting the money from the government, they add a spread. They turn around and loan it out to the consumers at a spread. But the standard checking account really provides little value in return for customers, even though you may have been a customer of the bank for decades. But separate, these two products that we use on a daily basis, they really don't provide any benefit. You're putting all your money into a bank, and then you decide to pay your bills, and your mortgage is one of those. But when you combine these two products with this enhanced engagement between your mortgage and your checking account on an automated basis, that's what's providing the savings. The deposits are used to lower your daily principal and save you more in interest on your loan than you could possibly earn in a traditional checking account. Now, I want to stop here and say, listen, this is only for cash flow positive people. If you're squeaking to get by, this loan is not for you. There's a higher barrier of entry that we'll talk about in a minute. You have to have a certain credit score to get this loan. You have to have a certain amount of reserves. So it's not for everyone. But I want to talk about, all-in-one loan, how interest is computed. It's computed differently. It's computed nightly and it's computed on a daily balance and added up at the end of the month. And then those daily amounts are paid on the third week of the following month. Monthly interest payments aren't due to the 21st of each new month. And what that does, it keeps your money working hard for you for an additional 20 days. So the per diem interest amount becomes lower every single day that you're going through the month. And so instead of structuring this loan like a traditional mortgage that's a ball and chain, we restructured it, the traditional mortgage into the nation's only first lien position, 30-year draw, 30-year payback home equity line of credit. And we did this because we see the value in keeping money liquid. Wouldn't it be great if you had access to every payment, all payments that you've ever made and applied to your mortgage over time, that you could literally just reach back in and pull that money back out? Here's the thing. You can put money in to drive the balance down, which obviously saves you time and money, but you can also pull the money out 24/7 over 30 years. Now I'm going to talk about how that works, because you don't get access to 100% of your equity, and the equity limit is going to shrink as you go forward. But here's the thing. What if you needed a hot water heater, or needed to renovate, or needed a new roof, or you could take it right back out of your home. You needed to pay college tuition. The all-in-one loan, it allows you to do that. It allows flexibility to do these things. So we approve clients to a certain HELOC limit that's relative to the guidelines, and that remains unchanged for 10 years. So in the example that we used of an $800,000 home with 20% down, with a $640,000 starting loan limit, that $640,000 credit limit would remain at $640,000 for the first 10 years. Okay. And then after 10 years, what's going to happen is we need to enforce a nice, smooth, comfortable pay down. And we do that by reducing the line by 1/240th every single month. So it's literally a 0.5% reduction in the credit limit every year or every month over the next 240 months from year 10 through year 30. And that's how we enforce the payoff, but keep you liquid without causing a balloon payment or restructuring the loan. There is no balloon payment. So there are some products out there that are first lien position HELOCs. They don't go 30 years and they have a balloon at the 10th year. The all-in-one loan is the only 30-year draw, first lien position, 30-year payback, home equity line of credit. So when you pay down the mortgage, the money remains liquid to buy another property. You could pay for college, medical expenses, or whatever's happening in your life. Literally, cash is just converted into home equity. In week 3 of the following month, the interest is charged to the account. So it's a paradigm shift. There's no more mailing in a payment or electronically sending in a payment. It's the interest that's due is automatically drafted from the account on the third week, which satisfies your monthly payment obligation for the month. So each month, you're being the interest due, you're charged the interest due, but the rest of the funds deposited are paying down your balance rather than sitting into a checking account. So what happens over 4 months in an all-in-one loan would typically take a 30-year mortgage about 12 months. So let's look at an example here. This is what happens in this particular scenario, which is a very conservative one, by the way. Historically, across the board, the average pay down time is somewhere around 9 years, or about 9.2 years. But remember, the line doesn't close. It remains open for 30 years. There's no delinquencies that we've ever had on this loan, no defaults in the history of it. And I think you can kind of start to see that how this is a win-win for not only the client, but the lender. Now, the lender is going to typically make less on this loan than a traditional 30-year fixed loan. There's a shorter pay down time. But what's happening is there's a longer relationship. We have clients that have had their same all-in-one loan since 2007. Now, I really challenge you to find anyone in your life around you that's had the same loan since 2007. Very, very rare out there in the traditional mortgage world. With the all-in-one loan, we have many clients who've had the same loan for 10 years, 12 years, and they've paid their balance down to zero multiple times. but the line doesn't close. They're still able to go back, draw money out, redeploy funds to make other purchases, to perhaps even invest in other real estate. In this example, one of the biggest things I want you to see is that the comparison loan effective APR is 1.307%. What this means is that the loan for this product would need to be the loan for your current loan would need to be 1.307 in order to match the same interest it's paid. And we're using a 4.25% example here. Here's some testimonials. Jason says, I hate to get emotional about a financial product, but the all-in-one has changed the trajectory of my family's life. And thinking about where we were and where we are now makes me emotional. We refinanced a loan that we'd had for 16 years, right at the point where the payment reached 50-50 between principal and interest. Once we got the all-in-one loan, we were able to pay the rest of the loan off in 20 months, saving us 12 years in interest. The freedom that comes with paying off debt so quickly is truly a blessing and something everyone should look into. Randy and Donna say, we were originally hesitant in believing the power of the all-in-one loan. We were given the option of the product on a primary residence or our investment property, and we opted for the investment property to see how things went. When we saw that our payments went from $1,450 down to $688 by putting money to work for us versus letting our money sit idly in the bank, we now have the AIO in our primary residence as well. We estimate our interest savings between the two properties will be $247,000 and pay off both properties in about 5.5 years. I'm not going to read all of these, but you can see here that you have self-employed people, you have CPAs and business owners. So we certainly service not only the CPAs, but also their clients, financial planners. I'm regularly sitting on Zooms or sitting in on masterminds or presenting to groups. You may have heard of Justin Colby. Justin had a mastermind recently. He's got about 1,000 students nationwide. He brought in his top 20 students to Denver, inviting me out to come present on the all-in-one loan, which was just a tremendous opportunity, and I'm very thankful for that. But that's pretty typical of what happens. And usually when I go walk out of the room, there's people that want to hop on a Zoom immediately. They want to, hey, can I meet with you next week? So it's extremely powerful. Some more testimonials, and these are all on the website, allinOneLoan.com. That's 4 words, allinOneLoan.com. Now, here's some program highlights. We talked about the enhanced engagement between your checking account and your mortgage. It provides 30 years of draw access to equity money, no balloon payment or prepayment penalty. It allows for loans up to $3 million without any geographical limits. And what that's just referring to is Fannie Mae, Freddie Mac has geographical loan limits. For example, I'm here in Nashville. The loan limit for conventional loans is somewhere in the high 700s. However, it's much, much higher when you say go to Miami or you go to Seattle or you go to LA, much higher. We don't have those, we're not beholden to those Fannie Mae loan limits. It can be used for a purchase or refinance of a primary, second home, or investment property. You can do cash out or rate and term. You can do single family as well as multi-unit homes up to 4 units. Now, one of the tools, resources that I promised you is going to be the interactive comparison simulator. It's again right here on the allinOneLoan.com website that you can go to. And last but not least, here is a QR code rather, that you can actually use to contact me if you would like to set up a time to chat. Now, we do set aside and block times every single week on certain days to go over and share with you these opportunities. We do take our own out of our own day. We block these times. They do fill up quickly. So just be aware that we may be booked out a week, 10 days. But if you would like to book a time to chat, you can do that. And now we'll see if we have any questions. All right. So one of the questions here is, why would I not just pay down extra on my current mortgage? It's a great question and one that's commonly asked. And here's the thing. Depending on where you are with your loan, it could be that it may be better to pay extra on your current loan. The only problem with that is, and what the simulator will show is how long you're going to be in the loan. So if you're paying the minimum payment and you're not really incentivized, and remember, we talked about there's really a disincentive to pay extra into the loan, right? Because the money only flows one way. You can put money in, but you can't pull money out without refinancing or taking out a second lien with a traditional loan situation. If you think about the all-in-one, we just went through a global pandemic, and God bless us all, but somehow we made it through that. But during that time, we had many people that called, texted, emailed, sent us messages, and they said things like, yeah, hey, my husband lost his job, or we lost our business, our income went down tremendously. But the one thing we didn't do is we didn't lose our home. And that was because of this loan. And thank you. And so it's those types of calls and messages that we get that really, really is powerful and really drives me. I mean, it really irks me and that more people don't know about this. And so you wonder, well, why aren't more banks doing this? Well, here's the thing. We close about $100 million per month across all channels with this product nationwide. So we're on a mission, um, and one loan, one family, one household at a time. And, that's all we can do. Again, 94% of people have a 30-year fixed mortgage. It just seems odd to me. I don't know about you, but like that someone who's maybe got a salary of $40,000 might have the same mortgage as someone who's got income of $500,000. Those people have different needs. They have different debt strategies. They have different equity strategies. They have different retirement strategies. They have different levels of debt. And so, what I've found from working and serving clients over the last 10 years is that whether the product works for the individual or not that's being presented with the opportunity is 100% of the time they're thankful that they now know about something that they didn't know before that existed. So thank you for that question. Um, what happens when the account is paid down to zero? So when the account is paid down to zero, the line does not close. You're not paid any interest yield on the account. What happens is if you continue to deposit money into the account, it's just going to have a positive cash balance. So oftentimes what we have people do is we pay their loan down to zero. They maybe continue to deposit the funds, or maybe they start using some other investment strategies until they get ready to deploy some funds. And then when they get ready to deploy funds, all they have to do, you have a check card. The bank account comes with a fully functioning bank account. I kind of sped through that slide, but you have 24/7 banking. You can use um, PayPal, um, any kind of electronic banking that you want to do, anything you want. It's a fully function. You can send wires. You can fund real estate deals. So you have checks. If you're still one that likes to write checks, you're going to have your own checks. And the cool thing about it is, there's not a brick and mortar presence typically for the servicers of the banks that operate and service the integration of this product. However, there are over 2 million uh, ATM machines that actually will allow you to take money out of nationwide. And when you are charged the fees, how you go to a Mapco, or you go to Kroger, or you're going somewhere that's not your bank. Maybe you're on a city street, and you go to the most uh, local closest ATM, and you're charged $3. You're going to be reimbursed those charges. So it's a very cool feature in that regard. Let's see. See if we have another question here. Okay, so are there any prepayment penalties? No, there are no prepayment penalties. Um, Absolutely not. There's no prepayment penalties. Here's another one. Let's see. Are the funds completely unrestricted, and can I use the money to borrow buy other real estate? You absolutely can. There is no restriction on the funds. You don't have to explain why you're taking the money out. You could be taking the money out to buy real estate. You could be taking out the money to take your entire family and your extended family on a trip. You could take the money out to invest in other things. Great question, Rick. Let's see. All right. If you don't have any other questions, I'm going to end now. And always know that using the QR code, you can reach me right there. The link is also in the chat, so you can access the link there and access my calendar and select a time for you or your family member or a friend. And you can certainly share this with them. So thank you. Thanks for tuning in. And until next time, we'll see you here on the All in One channel. This is Mark Neely signing off. See ya.